Yep.
Okay,
Um,
so let's turn it over to Leah. Leah's going to talk about trends in financing, and let's take it away.
yeah, I think this is a really good segue because the conversation has all kind of been about prices going up, things getting, more unaffordable, cap rates getting compressed, and one of the fallbacks that we can always kind of point to is, well, interest rates still make the fundamentals make sense for buy and hold investors. We've seen interest rates come down significantly in this crisis, and therefore they've held uh, performas, where you can still have good returns. So we get asked this question all the time, and if you've heard this question posed to a lender recently, they're always really coy with how they answer it. People want to know, like, well, what are the interest rates? What kind of rates are you locking? And it's such a loaded question because there are so many different variables that would determine what your specific interest rate would be. One being your borrowing profile, right? Who are you and how do you qualify for that loan? But also, how much money are you putting down? Are you buying points? What's even available on the mortgage-backed securities market, that they can sweeten the pot with some coupons or some points. So that's why you can't pin somebody down with a firm answer. You can always ask someone retroactively, what did you close with? But you should always know that you need to probably ask a couple follow-on questions for that information to actually be useful for you. Generally speaking, the conventional loan right now is somewhere between a 3.5 to a 4.5% interest rate. Again, that range being dictated by your borrowing profile, your down payment, and by what loan options are available to you, what coupons are available to you when you lock your rate. We have said this many times, but for investment loans, there is a requirement for you to put a minimum of 15% down for most investment lenders. But if you only put 15% down, you have to then pay PMI, private mortgage insurance. And so by the time you factor in this additional monthly insurance, it slashes your cash flow, and it just doesn't make sense for most investors to put 15% down. So 20% is pretty much the norm for most investors. And certainly with our preferred lenders, 20% is the norm. But you can put down 25%, and that does usually get you a better interest rate. And the reason I kind of wanted to have this topic today was because I recently experienced this with a closing of my own. I've previously kind of always just been like let's put as little money down as possible, just to kind of boost cash on cash returns, and just to keep my risk as low as possible from a financial perspective. But on a recent closing, actually my last couple closings have all been 25% down because I'm just seeing that it's more lucrative at this point to get that little bit of savings over time. And in particular, I've noticed there's been some really incredible rate lock options. In fact, when I locked my rate for a property I just closed on last month, the lender came to me with 5 different rate lock options. 2 of them were, if you put 20% down and purchase $1,000 worth of points, it'll be this. If you put 20% down with $2,000 of points, it'll be this. If you put 25% down, I mean, he had all these different options. And my husband and I sat down to kind of look at them, and initially our less is more kind of mentality was kind of leading, and we're like, oh, let's do 20% and let's do the points so we get the lowest rate out of those 2. But then we decided to kind of back up a little bit and put some of those numbers on an Excel spreadsheet and kind of look at what they actually did to the loan over time. And we found that it actually made the most sense for us to put 25% down and buy the highest point that was offered to us, because it brought our rate down to I think it was right at 3.5%. And so I had this experience, and I wanted to bring it to you guys to kind of help the people who are stuck maybe in the same mentality of like less is always more, because the truth is it's not. And I mentioned this to one of our preferred lenders last week. I said, I observed this. I've never bought points before, but it made so much sense for me to do. Are you seeing this happening a lot? And our preferred lender said that he has sold more points in the last 6 months than he ever had, that he has just seen really lucrative coupons being offered. And he said previously they wouldn't really sell a lot of points because the crossover point or the payback rate was usually, 7 to 8 years. So basically that's saying in order for this to financially make sense for you to earn that money back, you'd have to know with certainty that you were going to hold on to that property and not refinance for 7 to 8 years. And for a lot of buy and hold investors, that's a little bit too far out for them to put the money up for it. But he's noticing that today the crossover point or the payback rate is significantly shorter. In fact, the one that we just did, the crossover point was 18 months. So
Wow.
I knew with certainty I'm going to hold this property for more than 18 months, duh, So yeah, let's put the money down. And so it was after talking to him that I was like, I think this is something that might be a unique opportunity in today's market that maybe we haven't seen before. I threw this little formula on there so that you can calculate, whether this makes sense for you financially. So in order to calculate the crossover point, you want to take the total cost of the points and divide it by how much you're saving each month. And that will tell you the number of months that you would have to hold on to that property to earn back the points that you paid to buy that lower rate. And so I kind of approached this in two different ways. I mean, the first step that I did was I pulled up our property evaluator. This is available to you guys on realwealthnetwork.com. So I'm on the homepage here. This is before you're logged in, realwealthnetwork.com. You hover over the invest tab there. We've got a property evaluator at the bottom right. And this is a Excel file that we made for you guys. It's pre-populated with formulas, and it's got 3 performas side by side. And I found it just particularly useful in this situation where I want to compare the same property with 3 different loan products. And so I could just simply put in the math there. I'm locking a rate with my lender, so I have kind of all my disclosures locked in. I know my insurance, I know my taxes kind of roughly. And I was able to see, okay, which one offers me the highest cash on cash return of these different loan products. And then from there, that's when I went and did the final step of kind of finding out how long would I have to hold the property to earn that money back. And that's what ultimately led us to that specific rate that had us putting a lot more money down than we initially thought. But over time, it was better for us.
Leah, did you look at ARMs at all? Was that even within the realm of possibility?
I have never considered an ARM. I wouldn't even know how to analyze that. Is that something that you look at usually?
And I usually end up not doing it, like, gee, the rate's way better with a 5-1 5-year ARM set at a certain rate that's much lower than the fixed, but then it resets at 5 years. And then I'm like, I'm going to go conservative and I'm going to do the 30-year fixed. And then 4 years later, I'm refining anyway. It's
Right.
just like, ah.
Right. Well, and I think it's really easy to lose track of what you paid for something over time too. Like, I
Yeah.
mean, arguably, like I probably haven't kept good enough records on all my previous purchases to really go like, does it make sense? But did I earn back the money that I paid for that loan?
Yeah, me neither. Yeah.
We spoke earlier about cash flow being squeezed with these prices going up. So for someone whose cash flow is very minimal, an ARM might be a good option.
Mm-hmm. Yeah.
Yeah, and I think Ben, in your conversation with Chaley, I guess it was a couple weeks ago, Chaley Ridge of Ridge Lending Group, who's one of our preferred lenders. I think she mentioned that sometimes ARMs are great and worth considering too. You shouldn't rule them out automatically. I tend to because I feel like I always heard of them being used during the last run up and people getting trapped in mortgages.
Well, yeah, they were, because they were getting people into loans that they shouldn't have gotten them into, and they had an artificially low rate. And then when the rate went to its normal rate, they were like, I can't even afford it. The mortgage is more than I make. But obviously you don't want to go down that path. But what always struck me, and my personal experience that I just mentioned, is that they say the average loan, and I'm going by memory here, I may be wildly off base, but the average loan is held for like 6 or 6.5 years, or maybe even less. So like you can get a 7-1 ARM and at 2 points lower, a 1.5 lower. Now, a lot of times I think now ARMs are not lower. That's it just depends. But there have been times when I've been trying to finance something and the 30-year fix is, 2 points or a 1.5 higher than the ARM. And I go the conservative route because I want to have the same payment for 30 years, darn it, and then I sell or I refi anyway 4 years later. So it was an insurance policy that I bought for 30 years that I didn't need, so that's all.
Right. The lender that I spoke with about this trend, he seemed to indicate that this is a result of Wall Street being a little bit more involved in just private money, not Fannie Freddie backed loans, being able to come in and be a little bit more creative in the coupons that they offer. And Joe, I know you've got a webinar coming up next week with a new non-conventional lender that we're going to be adding to our website. And I know in your due diligence of them, you observed too that the rates that you can get on the non-conventional side are even pretty competitive, or more competitive now than maybe they were previously.
Absolutely. And they even have a 40-year interest only option where it's interest only for the first 10 years and then it goes to a 30-year fixed. So you get the best of both worlds.
Wow.
Yeah, that's crazy.
Okay, so you guys check out that property evaluator there and use that tool. It's there for you to download. I've mentioned our preferred lenders list. This is just to reiterate for you guys where you can find our list of preferred lenders. This is from the left-hand navigation bar when you're logged in to the website. So this is from the investor portal. You can hover over lenders there, the bottom left, and you'll see, I think we've got 5 or 6 different lenders there now. Again, all specialize in investment loans. All are licensed in all of the different states where we have property teams. There's 1 or 2 exceptions in 1 or 2 markets, but by and large, they can all do loans anywhere. And so if you are not already working with one of these lenders, I think you should absolutely consider it. If you are under contract on a property, you can't lock your rate usually until you're 30 to 45 days from closing. But certainly if you're under contract on a new construction property, and with reasonable certainty that you're going to be closing here in the next month or so, get on a call with your lender and talk through some of the rate lock options and do the math to make sure that you're selecting the loan product that actually is the most favorable for what it is you're trying to do. Especially now, I mean, I had the thought, because it's like, okay, my thought again has always been, don't pour more cash than you have to into the asset, just control the asset with as little money as possible. But right now, deals are so few and far between. I felt like, okay, well, I can keep this money out and then it's just sitting in my bank account waiting for the next opportunity, or I can just go ahead and, deploy it today. Yeah, I've got a little more cash in that deal that I wanted, but the cash on cash return, that money's working pretty hard for me, harder than it would be certainly sitting in my bank account. So definitely get cozy with the math and make sure you're making the right decisions there.
Hey, real quickly before we move on to Ben's presentation, I wanted to ask you guys, what is your thought about, let's say somebody wants to buy a brand new construction property through our network, and it's going to take 10 months, let's just say next year, next spring or next summer it gets done, right? And what if the projections say one thing, but then the interest rate goes up in 10 months? What's your thought about that? I mean, obviously we don't know what's going to happen, but do you think someone would be better off buying a rehab property at that point, or do you think somebody should just continue just getting a new construction home? Dealer?
I was the first one to jump in, so I don't want to cut anybody off. I think it's a risk that you're taking, right? I mean, I think you've got to have the reserves, you've got to have the financing to maybe be able to push on, even if interest rates do come up a little bit. Again, I think it's a probability thing, right? No one can know with certainty what interest rates are going to do, but we can look, like to Joe's point, at what the government's doing and where the government's motive is, and probably assume interest rates are probably going to stay pretty low. So interest rate being up or down 1 percentage point is probably, at least with the types of deals that we buy, that's probably not going to be make or break to the long-term decision of purchasing it. But yeah, I mean, I think it's a risk. I wouldn't want to commit to too many new constructions, I think, just because, yeah, the further away you get, the more variables can come into play.
Yeah. At the price points that we're at, a half point or a point isn't usually that big of a deal, and I don't think it's enough to really erase cash flow and put you in a negative cash flow situation. But I wouldn't want to put a dozen under contract. If suddenly, they close in 24 months and interest rates have gone from 4 to 6. It's not necessarily going to be devastating, but the chances of that are pretty slim. But maybe not put a dozen under.
Right. Well, that's yeah, thanks for answering. So that's great. But to use our property evaluator that Leah was just talking about, is download that, run the numbers, run your numbers on if at let's just say 4% interest rate is kind of what we have all of the performers as a sample property on our website. We all run our performers at 4%, but run it at 5% and see if the numbers are still okay with you. And if they're still okay at that point, then I would say it's safe to be okay with that.
Yep.